Hello, my name is Nick Griffin. I am the Head of International Strategy at K2 Asset Management, and this is the K2 International Fourth Quarter 2014 webinar. This is essentially a recording we put together to update you onto our views of the world, how we think it will evolve going forward in terms of growth and in terms of markets, and also to give you a quick update on the portfolio as it stood in the fourth quarter of 2014 and as it stands going forward. From that point of view, this presentation is entirely for your benefit. So if there is any ways we can improve it or any feedback that you'd like to add on what we're doing here, that would be much appreciated. And of course, if anything that I say in the next 30 minutes entices any questions or queries, please don't be afraid to get in touch with your local K2 representative or with myself directly. What we'll do here is we'll kick this off. It's essentially a 30-minute presentation with slides and commentary from myself, and we hope you enjoy it. The first slide is obviously a disclaimer, which I'll let you read in your own time. The second slide is essentially the agenda, and as I said, what we're going to do here is go through the outlook for growth, the outlook for markets, an update on the portfolio, which is essentially just to provide some transparency on your investments. We're also going to spend some time talking about the energy market and also the Internet of Things, which is an area where we think we can make good money in 2015. And then finally, we're just going to give you some concluding thoughts. So kicking off now, just in terms of the outlook for growth, the first slide I'm going to show you here is essentially US real GDP consensus forecasts over the last 4 years, and the last 5 years, sorry. What this slide shows you is essentially that at the start of every single year we start with, or consensus starts with a 3% forecast for US GDP, and it gets progressively downgraded as the year goes on. Despite those progressive downgrades, all of these years were positive years for the US equity market. And so what we've seen consistently here for some time is that growth has been somewhat disappointing, yet equity performance has been okay. As we move into 2015, we have another 3% forecast for growth in the US, and it'll probably continue to slip in 2015, but probably not as bad as previous years. And if anything, it is worth flagging here that the US economy is recovering throughout this period, albeit sluggishly, and that recovery has continued, and in 2015 it is definitely maturing. And so from that point of view, there's going to be a number of changes, most notably on interest rates and other issues as we go through 2015. But as we start 2015, 3% growth in the US, probably more likely than it was in the previous years. The reason why it's more likely is here on slide 6. This is essentially US non-farm payrolls in the US, and it's a 6-month rolling average. And what you can see here is pretty much for the last 3 years now, we're averaging roughly 200,000 new employments a month in the US, which is similar to the averages pre-financial crisis. And so it's been a very robust employment environment in the US. US unemployment's now dropped below 6%, from being as high as close to 10 in the financial crisis. And from that point of view, in terms of achieving its outcome of price stability and full employment, the Fed has been successful in getting us to full employment. The only problem with this slide is obviously it doesn't show the participation rate, which is still low, and obviously real wages also have not grown significantly through this period, but people are employed, and that's good for the US economy. What this means now in going forward onto slide 7 is that in 2015 we're probably going to see the Fed move to hike interest rates at some point during 2015. This is significant because it's the first interest rate hike for 8 years, and from that point of view, with full employment now in the US and some price stability, from that point of view, the Fed should be hiking rates, and ultimately we think if they do it for the right reasons, it's the right thing to do. Important to flag here that the medium Fed projection for interest rates, and this comes from their minutes, points for quite a strong hike in interest rates over the next 2 to 3 years. The futures market is actually looking for less than that, and there is some dislocation here. But ultimately, the Fed has stopped doing QE. It's removing accommodation from the marketplace, and we expect that to continue in 2015, provided the economic data holds up. But to be clear, they are data dependent, but there's nothing in the data to suggest today that they won't hike rates in 2015. The reason why they can do that, and the reason why this also is probably likely to create a bit of volatility, is due to these global purchasing manager indices. Is a good example. Is ultimately the US is the only real developed economy in the world that's showing significant growth at this point in time. So what we're showing you here is purchasing managers indices, or PMIs. And if you're above 50, that's generally positive, and if you're below 50, that's generally negative. At this point in time, you can see quite clearly that the US is significantly outperforming the Eurozone, Japan, and emerging markets are actually going a little bit backwards. So growth there is somewhat negative. Or is getting worse to a certain extent. And so from that point of view, we have this strange situation in the world where the US is looking to remove accommodation, i.e. hike interest rates, but in Europe they're looking to increase accommodation through their own version of QE. Japan is already in its own version of QE. China is cutting rates, and obviously Brazil is much more affected by the oil price, etc. But we have this world where there is a lot of accommodation outside the US and less accommodation inside the US, and this is creating a lot of volatility. We saw it in the second half of last year, and we're seeing it this year, mainly around currencies, but also in commodities, interest rates, and ultimately equity markets. Just to give you a highlight of that volatility, and as I said, it mainly started in the second half of last year, mainly around stronger US dollar, which is this top line here, very strong versus the yen and the euro, which are obviously, as we said, looking to provide more accommodation. And this is because the decoupling, I suppose, of the US economy with the rest of the world. The stronger US dollar has obviously put a lot of pressure on global commodities, but we also had the dramatic collapse in the oil price in the second half of last year, mainly based around supply issues, and that's something we'll talk about a bit later. But commodities are generally all exhibiting deflationary signs. And obviously all of the deflation that's coming through in commodities is pushing around sovereign bond yields, so we're seeing interest rates go lower. In some cases, very surprisingly so. So we now have German interest rates that are negative all the way out to 5 years. And so that is essentially dragging down US interest rates and other AAA rated corporates. So interest rates have gone lower despite the fact, even in the US, despite the fact that growth has got better. And so as we approach this first rate rise with the volatility that's in currencies, this is creating a lot of volatility in equity markets. And this is this bottom right-hand chart, which is the VIX index, which is essentially has been pretty volatile August, October, December, and now also January. And to be honest, with the rate hike potentially on the horizon, and obviously the increased stimulus from other parts of the world, it's probably likely that this volatility is going to continue at least through the first half of 2015. And then finally, just to flag, the key debate, I suppose, for 2015, at least at this stage, is what this is all going to do to inflation, because ultimately central governments are about full employment and price stability, and with the collapse in commodity prices, inflation is going to be probably 0 to negative in the first half of 2015. That ultimately should be transitory, because it is essentially just the oil price and other commodities. But what central banks will be wary of doing is letting deflationary expectations become ingrained in the marketplace. As I said, they are about price stability, and so from that point of view, we would expect central banks to err on the conservative side, at least in the first half of 2015, because ultimately they do not want inflationary expectations to set in. Ultimately, they are just commodity-based at the moment, but in Europe we'd expect significant accommodation, because ultimately even the interest rates, or the German interest rates in particular, are flagging that inflation could go negative, and that's not a good environment for growth, and definitely not a good environment for corporate earnings. So this is why we are going to get more stimulation. It is, in our view, transitory, but ultimately it's something worth watching, at least in the short term. So that's essentially the outlook for growth. Growth in the US is good. Outside the US, it's patchy. It's still another substandard year of global recovery. That's still creating low interest rates, and that is the environment for markets. Not dissimilar to last year, just more volatile, because different areas of the world are going different directions. And so how does that put us in terms of markets? Well, from our point of view, the markets still look roughly fair value. What we're showing you here is the S&P 500 valuation, and it's broadly in line with the historical average. The grey bars here are the earnings estimates of the S&P 500. Obviously getting stronger all the way up until the financial crisis, then some weakness, and now getting stronger again. The light blue line is the 12-month forward rolling PE of the US market, and essentially it is high. It's up at 16 times, but again roughly in line with its historical average. If we look forward 12 months, we'd expect US EPS growth to be roughly 8% in 2015, or high single digit. and the market can hold its multiple, and hence you can get a high single-digit return out of the market by this time next year. Despite all the volatility we had last year, that is essentially what happened last year. The market re-rated slightly, earnings were stronger, and the market was up 11% for the year. But at many points it was down for the year, at other points it was up more. But 11% was the eventual outcome for the US market in 2014, and as we go into 2015, the environment is still relatively similar. And so from that point of view, there's nothing on this slide, at least at this point in time, that worries us. The other thing just to be wary of in terms of equities that are going to support them going forward, and we've shown you this chart a lot, and that is the fact that the equity carry versus bonds is still positive. All we're showing you here on the right-hand side is the dividend yield of certain markets versus their risk-free rate. And so you are getting a positive carry for holding equities and dividends. Obviously, that's important for Australian investors, but you are now getting it offshore as well. And also important to highlight that the earnings yield of the S&P 500 is still well above the US 10-year bond yield. So not only do you get a higher dividend yield for holding equities, but if you are running a company or a CEO or a CFO, it's a very positive environment to create value to your equity account by simply essentially borrowing money and investing it in higher growing projects. You can essentially pick up on average a 4% carry. You can borrow money and buy back your stock and pick up a 4% carry, and you can obviously borrow money and buy another company and pick up a roughly on average a 4% carry or more. And so from that point of view, equities remain the asset class of choice. They are not as expensive as bonds as property. They are providing positive income returns, and they are providing positive carry differentials versus interest rates. So it's a great way to grow your savings pool still today. And so from that point of view, we do still think that money continues to flow for equities because the maths essentially adds up and has done for essentially the last 5 years, and we think it will continue to. Just looking at global valuations globally, this is just forward PE multiples and dividend yields. As you can see, there's nothing on this slide that particularly scares us. None of the multiples are looking particularly ridiculous at this point in time, nor the dividend yields versus the risk-free rates. We would flag the US is getting more expensive. It's up at 16.6 times, particularly versus Europe and the UK. We'd also flag that Hong Kong and particularly the China H shares are standouts in terms of valuation versus the marketplace at the moment. Just extending on that China H share point, it is worth flagging this is the 12-month forward PE of the China H shares on the bottom here, and this is the 12-month forward PE of the emerging market index and the 12-month forward PE of the US market. The Chinese market has been cheap for a long period of time, and from our point of view, we do expect that to change. We expect the Chinese market to re-rate somewhat over the first 6 months of 2015, as it did in the last quarter of 2014. Ultimately, China needs to shift from essentially run economy to a privately run economy. That's not only through private consumption, but also through private capital. And we see private capital being treated better in China going forward. You're already seeing that in the China H and A share connect. You're already seeing that in terms of SOE reform, share ownership plans for management of Chinese sovereign firms, and you're already seeing that by deepening bond markets, etc. And so from that point of view, we would expect the Chinese market to re-rate, and there is lots of room for it to re-rate. And we'd also expect the growth in China to eventually improve as private capital does what private capital does best, which is allocate more efficiently. And so from that point of view, it's worth flagging, we'll talk about a bit later, we do have a reasonable bet on Chinese equity markets as it stands out quite significantly amongst the peer group as a better place to be in 2015. Just a quick update on the portfolio. What we're going to do here is just run through how we were positioned for the quarter and how we're positioned going forward. As you know, at K2 we have 3 tools to offer to add value, not just the one. So obviously there's the one that every hand has, which is alpha. Which stocks do you want to be invested in and why? The second one is on variable beta, and this is unique to us. Do we want to be invested or do we not want to be invested? And the third one is on currency. Do we want to be hedged or do we want to be unhedged? And so from that point of view, I'll run through all 3 as to how we're positioned in the last quarter and how we will be going forward. Firstly, on net equity exposure, this just shows the net equity exposure of the K2 Select International Long Short Fund since inception. And as you can see, we can be as high as 100% exposed or as low as 40% exposed. Since the end of the financial crisis, we have felt it's been a bull market for the last 6 years, and we have remained very heavily exposed, and that's essentially been the right call. As we enter 2015, or the last quarter of 2014, we were above 90% exposed for most of the quarter. We did put on a few small shorts in luxury goods and in the energy complex, and as we enter 2015, we remain reasonably heavily exposed because, as I flagged earlier, we still think the environment for equities is positive, albeit we are 6 years into this, so at some point we are getting closer to the end of it, but at the moment we are staying fully invested. When the time comes, we will do this again, but at this point in time, we're not saying it is today. In terms of currency, we have, again, the same slide I'm showing you here, the ability to be hedged over time and the ability to be unhedged. We were unhedged for most of 2014, and we were unhedged in the last quarter, and ultimately the Aussie dollar weakened quite significantly in the second half of the year, and that contributed significantly to the positive returns of the funds. This is obviously heartening because we were unhedged. Going forward, at some point the Aussie dollar will stop falling, and we will move to hedge the portfolio again to protect the gains that we've made through this period, but at this point in time we remain unhedged. As you can see here, the reason why we're unhedged is because of the differing growth differentials that I flagged earlier in the presentation, which is essentially that US growth is strong, and emerging markets and other parts of the world are struggling, and it's similar in Australia, particularly with our leverage to the slowing China region. And so from that point of view, what you can see here is the Aussie spread of the Australian 10-year versus the US 10-year, which has continued to fall. And obviously the Aussie dollar has followed this. At June of this year, it was somewhat frustration because the spread was falling, yet the Aussie dollar was not. But the Aussie dollar has caught up significantly in the last 6 months. And obviously, as I said, a lot of the depreciation in the Australian dollar has meant that we have been able to achieve fairly significant positive returns in the second half of 2014. Going forward, as I said, with the commodity price weakness, we do expect the growth outlook in Australia to continue to slow relative to the US, and so we do think there is still room for further depreciation in the Aussie dollar, but ultimately, to be clear, it will stop at some point, and we will move to hedge the currency, and that is obviously closer now than it was 6 months ago. Just in terms of performance for the quarter, just a quick update on the various markets. These are the US markets here, which did reasonably well for the quarter. Europe was obviously less. This is for the last quarter, September to December 2014. Obviously, the big standout was the performance of the China 8 shares. As we flagged earlier, we think this change has essentially just started in the last quarter of last year, and we hope that it continues through 2015. And also important to flag that the MSCI emerging markets, obviously outside of China, struggled significantly because of the collapse in the oil price. For the fund was up 8.9% or 8.89% for the quarter, which was heartening, and we outperformed the index in good absolute returns. More than half of that came from the falling currency, which again was heartening, and obviously it was a heartening end to what was otherwise a reasonably difficult year. So a good result, and one that we were happy with and hope to continue as we enter 2015. Just a recap of major news events over the quarter. I won't go through this in detail, but you can look at it in your own time. The ones that stand out to us was obviously the oil price rout. Obviously the oil price fell more than halved essentially in one quarter, which, as I'll show you a bit later, is actually not that uncommon, surprisingly, but was definitely a major effect on markets. We also had the very strong US dollar effect that really accelerated in that fourth quarter, and obviously the problems in Russia. The only other thing I'd flag is just in terms of geopolitics. Obviously it continues to stay difficult, but there was some positive news with Cuba now reconnecting with the US in terms of diplomatic relations, and really completely and utterly brought about by the fall in the oil price, because Cuba essentially relies on Venezuela for cheap oil. Venezuela essentially stopped, and now Cuba has to re-engage with the US. And we would hope that while the oil price falling is obviously creating concerns for some people, there are some silver linings in terms of geopolitical politics that could in theory get better. Think of Iran, think of Russia, in an environment where their economies obviously get significantly worse on the back of the falling oil price. Just in terms of the stock position, so now we're onto the stock alpha within the fund over the fourth quarter. So this is the fourth quarter that just finished, and what we're showing you here is the local currency return in basis points. So not the Aussie dollar return, the local currency. The Aussie dollar return is on top of this. because obviously the dollar depreciated over the quarter. And obviously some of our bigger winners were in the Japanese banks, where we essentially took a view on more quantitative easing, which came through at the end of September, which was positive. Royal Caribbean Cruises was a big winner for us on the back of the opening up into Cuba, and also we managed to pick it up quite cheaply during the Ebola scare. We flagged already our investments in China, and they were a significant contribution to performance in Q4. All of these companies, CITIC Securities, Taipei Insurance, Bank of China, Galaxy Securities, China Life, they're essentially plays on the opening up of the Chinese capital market, but also the opening up of SOEs within China. And so that re-rating that began in Q4, we expect to continue, and we'll talk about that in the top 10 in a second. But big contributor performance of the fund in the fourth quarter, and hopefully a continually good big contributor in 2015. A couple of our core positions in Disney and Skyworks continued to perform well. We've discussed those a lot previously. I won't go over them again. The difficult stocks, the big one was LyondellBasell. This was our biggest shale player. It was a top 10 position for the fund for the last 3 years, and was a very, very good contributor to performance over that time frame. The company essentially more than tripled over that time frame, and we participated in a good chunk of that. Unfortunately, we stayed at the party too long. The shale environment in the US has obviously deteriorated significantly post the collapse in the oil price, and we exited this position during October. Ultimately, this company is a benefit of oil-gas arbitrage through its basic chemical production in the Gulf of Mexico, and the gas side stayed low, but obviously the oil side collapsed towards it. The only other thing to flag there is BWLPG was also on the same bet, has moved on. Google has been a very disappointing position for the fund all year. Nothing has changed really in terms of the earnings outlook of the company, but ultimately its shareholder friendliness has come into question, mainly around the fact it still doesn't pay a dividend, and also regulation, which is the big risk from our point of view, has come into question around the EU looking to break up Google. And ultimately we finally exited the position in October. We still like the company long term, but the results are just in line. There's no sign of change on shareholder friendliness, and ultimately we became concerned that it was dead money and decided that we had given it a long time and it was time to move on. And so from that point of view, we do think that Google needs to go through a sort of Apple-like change that Apple went through 18 months ago and become significantly shareholder friendly, both around the buyback and also the dividend, considering they have nearly a quarter of their market cap in cash as we speak today. And so from that point of view, we essentially became impatient. It doesn't mean we don't like the company and we won't return to it, but for now at least we have moved on. And to be honest, that has in fact been the right call, because the stock has continued to stay weak post us selling it. Just moving on to the top 10 holdings as at the 31st of December 2014. And as I said, there has been some reasonable change here. Obviously, some of our core positions in Disney, FedEx and Apple are still there. The Japanese banks have been there for a while, but the big change has been, as I discussed earlier, the increase in our China positions. The Mengshan Iron and Steel, China Life are essentially SOEs that have come into the fund. Industrial Commercial Bank of China is again another SOE in China that's come into the fund. And again, as we said, we're looking for the re-rating of the Chinese market here to continue. We're paid to take a view, and we've taken a view on China, and it's roughly 20% of the portfolio as it stands today, and ultimately among a few higher, bigger positions. Beyond that, Baidu is the only one on there that's not an SOE. It's a Chinese internet company, and below the line we still have, as I said, large investments in things like Royal Caribbean, Skyworks, and other ideas that we have going forward. But that's the top 10 as it stands today. Look, just a quick update on a couple of our big structural trends that we're looking for in 2000, or that we were looking for historically and that we are looking for in 2015. The first one is energy. We've spoken about the shale market a lot in the US over the last 3 to 4 years, and it has been a very profitable place for us to invest over the last 3 to 4 years. But ultimately that's now come to an end with the collapse in the oil price, and I think from our point of view we would see the oil price weakness as something that is going to be with us now for at least 12 to 18 months. After that, obviously the production will adjust, and we think the oil price can recover. But it's important to flag, and we've just got a couple of slides here to explain why we have exited the US shale positions and why we don't think they're going to come back into favour for at least a couple of years or 18 months. And so from that point of view, we're not bottom fishing US shale as we speak today. We exited very quickly probably would have liked to have done it quicker, but we have exited very quickly, and we're not going to be returning. And I suppose these are the couple of charts as to show you why. First and foremost, it's important to understand how the crude market works, and this first slide is just showing you the year-on-year production growth for OPEC, non-OPEC, the US, and demand. And as you can see along the bottom here, non-OPEC has been growing its production very slightly, OPEC has been growing its production very slightly through this period. Demand hasn't been great. It's been sort of flat to slightly positive through this period. And non-OPEC production has been flat to slightly positive during this period. So there's only really one thing that changed in the crude market in the last 5 years, and that's precipitated what we're seeing now. And that's that US production year over year has been growing very, very strongly. Much stronger than any of us ever thought it could. And this is essentially $100 oil meant they unlocked the geological equation. And by unlocking the geological equation, they have essentially cracked the shale market and seen huge production growth in the US over a very short period of time. And all of that was essentially taking share. If you look at the cumulative production growth since 2009, essentially OPEC is getting very little of the demand bar, non-OPEC's getting negative of the demand bar, and the US is essentially taking all of it. And so from that point of view, OPEC, and in particular Saudi Arabia, decided it was time to do something about this. From our point of view, we could see these numbers and we felt that this oil price weakness was still 18 months to 2 years away. But the Saudis have decided to bring that forward to today to essentially try to shake up the oil market and most importantly, shake out the US. And so I know there's been a lot of conspiracy theories that this is focused on Russia or Iran or other places, but from our point of view, this is very much focused on US onshore production. And so what OPEC did is they deliberately started talking the oil market lower. They started with a number of press articles. They then, as the oil price went down, we moved to an OPEC meeting where they refused to cut production and they called on non-OPEC to cut production. And as I said, despite the conspiracy theories, this is very much, in my opinion, focused on US shale. They're deliberately shaking up the oil market, and they know that US shale will be the first to come out of the market because, first and foremost, it's rational. If the price goes down, then if they're producing at a loss, then they'll cut production. Secondly, it's easy to switch it off because it's all onshore US horizontal. And thirdly, it's high cost. And so from that point of view, they're likely to be much more rational than, say, the Venezuelans, the Russians, or the Libyans in terms of oil production. And so if you take that all on board, then ultimately US shale production needs to shrink considerably to allow the oil market to rebalance and find a clearing price. And once it does find that clearing price, we'd expect it to recover reasonably quickly. But unfortunately, that's probably 12 to 18 months away. So from here, it's all a question of how quickly US shale production reacts. Aside from any other major geopolitical issue, that's the one that we'll be watching most closely. Also important to flag here on slide 27 that this is not uncommon actually. The oil price has halved essentially in a very short space of times, no less than 10 times in the last 15 or the last 20, 30 years. And so from that point of view, OPEC has a habit, and particularly the Saudis have a habit of shaking up the oil market like this to allow them to maintain or take market share. And so from that point of view, all of these times the oil price dropped very aggressively until OPEC got their desired outcome and then brought it back up again. So longer term shale still has a role to play, and longer term we still see lots of really good investment opportunities here. What we're saying here is that we've exited and we're not going to be going back anytime soon because this is going to have to play out for a 12 to 18 month period, and unfortunately it is going to be very focused on US shale. Finally, we don't think this is a massive effect for a massive pre-warning of global GDP. This is a supply-demand dynamic. It's been out there for a long time. Saudis have brought it forward to today. Yes, it will affect US growth at the margin, but important to realise that 70% of the US economy is consumption. So on the flip side, the lower oil price is definitely helping the US economy. So ultimately, we don't see this as a big economic signal for the US or for the world. It's essentially just something that's playing out in the oil market that has happened before, and this time it's Saudi versus the US. Previously it was Saudi versus Venezuela or Saudi versus Indonesia or other OPEC members. But this time it's Saudi versus US, and that's how we think it's going to play out. The only other thing we wanted to flag is essentially the Internet of Things. This is a big investment area for us in 2014, and we did quite well out of it in 2014. We expect to do better out of it in 2015 because we think this is really starting to accelerate. And what do we mean by the Internet of Things? This is essentially the Internet of Everything, is another expression for it. And what we've had is in the world that three things have effectively happened. One, the cost of producing electronic devices continues to fall precipitously under Moore's law. 2, they can now all be connected because the internet is everywhere. It's in your home in Wi-Fi and then outside your home in terms of wireless connecting. And 3, we now have cloud computing that can connect all of that information and bring it back to every device everywhere. So amongst you, the person at the bottom here, you now have up to 10 devices that are connected to you, be it your TV, your car, your radio, your games console, your tablet, your computer, your phone. And all of that information is going to a cloud. For a lot of you, it's probably iOS or Android. And then there's a bunch of apps that will update you on either your car or the security of your house, or how many steps you took during a day if you're wearing a Fitbit, for instance. That's how it works for a person. And then on the top here, for the economy as a whole, or for industry, where you have factories that are essentially connected, valves that are connected, hospitals, healthcare, pacemakers, municipal products, etc., etc. And so what this means, we're getting essentially an explosion in connected devices. And this is what I'm showing here on slide 29. Essentially, you're moving from 1 to 2 connected devices to person to 10 to 12, plus they're going to industry. So we're rapidly on our way to 50 billion connected devices by 2020. And this is a logarithmic scale. And so what we expect is this is going to accelerate very significantly, particularly in 2015, 2016, as these real connected devices start to really penetrate mainstream. And here we're talking about wearables and businesses that are doing this. This has a twofold effect. 1, there's going to be a lot of devices. And 2, there's going to be a heinous amount of data that needs to be processed from these devices to give you the real-time updates. And so from our point of view, we're playing this mainly from the connected devices point of view. And so what we're showing you here is the Internet of Things trend and the different ways of playing it. And from our point of view, we're very much at the top of the screen here with the foundry players, mainly Intel and ASML. Intel's a foundry, and obviously ASML is someone that makes the machines that go in the foundries. And so ultimately, every device has to have a semiconductor in it. And on top of that, all the data centers need some seriously high-powered semiconductor devices, mainly from Intel, to essentially process the information. And so from that point of view, this is a pure volume play for the top level line here. The second line, again, is a pure volume play, which is around connectivity. So these are the antennas that go on the devices, and that's where Skyworks comes in, which we've had for a long time, and we've added to it with Avago. And then below that, we'd also flag security is going to become much more important here because everything's going to live in the cloud. The bottom of the slide gets a bit harder, and these are the cloud players. From that point, or the data center players, and from that point of view, it is very competitive. It's worth flagging that a lot of this data is going to be combined amongst just a handful of cloud players in the long run, namely Apple, Google, probably Amazon. And so from that point of view, finding the platforms down here is much harder, but for what it's worth, we still like Apple. Visa is obviously and MasterCard a good platform case because that's how the payment system's going to go. And the rest of these companies we like, but we're not invested in at the moment. And just to be aware, it is getting very competitive amongst the platform. So there's a lot of zero profit competition going on, which is concerning people, and obviously concerned people around Google this year. But from our point of view, this is really going to accelerate this year in 2015, and we had some big winners here last year, and we think it will continue, and it's mainly at the top half of this slide. Look, finally, just to conclude the end of the webinar, look, the December quarter was a positive quarter for returns for the fund. For the K2 International Select Fund, it was up 8.86%, with gains on the Aussie dollar predominantly, but also gains particularly in China, Japan, and the US. Look, on capital, we remain positively disposed to markets in 2015, and hence we maintain quite a high equity exposure. Basically, there's still predominantly low interest rates, and the positive equity carry should allow equities to continue to prevail over subdued growth and basically difficult politics, which is what we saw last year. The key risks are likely to come from any embedding of deflationary expectations, and obviously from any further interest rate hikes in the US outside of growth, or i.e. policy mistakes. But ultimately, while it will be more volatile, we are still positive equities in 2015. On FX, we remain unhedged to the Aussie dollar, and we expect the Aussie dollar to continue to weaken over the medium term. Probably not at the rate that it did in the last half of last year, but we do see the bias still to the downside. Over the longer term, we obviously have the ability to hedge the currency once the depreciation is complete, and we will let you know when that's happened. Look, on the stocks, we have a lot of good ideas that we've had for a long time, mainly around content, mainly around the internet, that still prevail in the portfolio today. On top of that, in terms of new ideas for 2015, we've obviously exited the energy bets, as I flagged earlier, and we are now moving to focus more strongly on companies that have more sustainable dividends in a low growth world where rates are probably going to go lower. than they already have. And we're also looking to focus on companies that predominantly have strong US dollar earning streams, both in the US domestic and then outside the US, either in Europe or Asia, but with US dollar earning streams, as they will benefit from the strengthening US dollar. We're clearly, as I flagged, looking for companies that are geared to this amazing explosion of growth that we're about to have in the Internet of Things. And then finally, we do have a reasonably large bet on China SOEs that we think will better benefit from liberalising of capital markets and a bottoming out of growth metrics in the regions. So essentially that is the webinar for the fourth quarter. We'll do this again at the end of the first quarter. As I said, please give us any feedback on anything that I've said over the last 32 slides if it finds compulsory. And if you have any further questions, please don't be afraid to get in touch. I hope everyone had a good break, and I wish everybody every success for 2015. Thanks very much.